What if there was an investment that could generate 10% plus income yields in retirement? Meaning that you put $1 million into this investment and $100,000 plus comes back to you on an annual basis. Well, this is exactly what covered call ETFs like QYLD, RYLD, and more claim to do. For an income-focused investor in retirement, this seems like an incredible offering. In today's video, we're going to give you clarity on whether these covered call strategies deserve to be part of your retirement portfolio. So let's say you're someone that recently entered retirement. You have a sizable nest egg, and now you're looking at how to turn that portfolio into income that you can live on. Many investors flock to income investing for this exact reason. With this, the focus is on income yield. If I put $100 into this investment, how many dollars am I going to get back to live on? As of recording this video, here are a few popular options in the income investing space. You have bonds at 3 to 4%. You could buy a broad dividend ETF at 3 to 5%, or there are these covered call ETFs that have an income yield well above 10%. Well, if we're just focused solely on income, it's not hard to see which option looks most attractive. Well, some of the biggest misconceptions and mistakes in retirement investing come from focusing solely on the income side. Income investing in many cases has been used as a marketing tool. Investment companies know there is a huge swath of investors that have difficulty looking at a portfolio and figuring out how to turn that into income. And so they'll make decisions primarily based on income yield. But income yield is just one part of the investing equation. Every investor in the world should be focusing on something called total return. It doesn't matter if you're 20 years old, just starting your investing career, or you are 65 and trying to live off your assets. Total return is what matters. As we will show, an investment can give you an income yield of 5, 8, or even 10%, but ultimately still lose money. Income yield says nothing about whether your principal is growing or losing money. It just shows how much you're taking from your portfolio. Income investing isn't safer. Income investing isn't some superior investing strategy. All it is half of the main investing equation. That's it. And let's show why focusing on half of the equation can lead you astray with covered call strategies. For those that aren't familiar, let me first explain briefly what a covered call is. We'll use a hypothetical example with an index fund ABC. A covered call strategy involves owning the index or the index fund just like you would any other stock or fund. In this example, you own 100 shares at $100 per share. Then you're going to take and sell something called a call option on top of these 100 shares. Now, we won't get too far into what a call option is, but it's essentially a derivative of the underlying security. In this scenario, you are selling a call option, which means you get to keep the premium of that call option, which in this situation is $1.50 per contract for $150 that you take in as premium as income. Now, with selling a call option, you change the payoff diagram of this strategy. For instance, if you own the index fund outright, if that index rose from $100 to $101, well, you make $1 per share. If it fell to $99, you would lose $1 per share. A covered call works a little bit differently. By selling a call, you cap your upside significantly and slightly hedge your downside. Here's what the payoff diagram looks like. With an option, there's something called an expiration date. In this example, let's say that's 1 month from now. If in a month, ABC index finishes above $100, it doesn't matter where it finishes above $100, you will get the premium from selling the option, that $150. Between $98.50 and $100, you will receive some prorated amount based on where it falls within that range. By selling that call for $1.50 per contract, you created a hedged zone where the index can theoretically lose money and you will still make money because you took in that extra income. Then if the index finishes below $98.50, you will lose dollar for dollar alongside the index. You have uncapped downside, or rather, it's capped at full loss, 100% loss, if you will. You could lose everything if the index or stock fell to zero. This is where I explained off the front end that positive income does not mean positive performance. In this example, if the stock went to zero, you generated $150 worth of income, but you lost everything in the process. And so you get to spend your $150, but you lost that full $10,000 of principal. Now let's just step back and think about this situation for a second. Yes, a covered call strategy does allow a bit of hedging. For this reason, it will decrease volatility slightly, but does so at a major cost. We know that markets can be volatile, both up and down. If when the markets go up, we collect a little bit of income, but miss out on the upside appreciation, and then on the flip side can lose a bunch when the market falls, that seems like a pretty tough trade-off to win on over the long run. Let's go a bit more granular in this example and show some payoffs of a covered call strategy versus owning the ABC index outright. On the downside, if the index falls by expiration, we will see that a covered call strategy improves outcomes marginally. For instance, if the index fell 10%, you would only lose 8.5% rather than the full 10%. We also see there is a positive outcome if the index doesn't move at all over that full month. But again, the cost of this strategy is shown when markets grow. By accepting a small benefit in a flat market, you give up a substantial benefit in an up market. And the problem with this is that participating in up markets is incredibly important. Many of you have likely seen variations of the data shown on the screen in examples of trying to time the market. For instance, if you had $10,000 invested over the last approximately 30 years, and you invested 100% of the time, your $10,000 would have grown to $158,000, some pretty substantial growth. If you missed, however, the best 10 days in the last 30 years, you'd have half as much. If you missed the best 30 days, you'd have 83% less money. Again, this example is typically shown to show the benefits of time in the market rather than timing the market. But we can take the same idea on a monthly basis and try to gain an understanding for why covered call strategies hold your retirement back. Again, remember that a covered call strategy essentially caps your upside. So let's take a look at data from 1927 until now. If you were fully invested in the stock market during this time, your money would have grown by nearly 10% per year. $1,000 invested would have grown to over $8 million. But let's say you missed out on the best 30 months. Your performance would have nearly cut in half and grown at only 5% per year. The same $100,000 would have only grown to $127,000. A night and day difference showing just how important gaining that extra upside is. And if we were to map monthly stock market performance onto a distribution chart, you would see a graph that looks something like this. What this is showing is that the average monthly return in the stock market is just under 1% per month. Basically, the majority of returns and general skew of results is positive. And then on the outer tails of the graph, we see less frequent but high magnitude events in both directions. There have been times when the market fell 20% in a given month, but there have also been times when the market has risen 20% in a given month. Now, if there was a strategy that eliminated both of these tails on both sides, well, that might be attractive to a retiree. It would eliminate a lot of volatility. But that's not what a covered call strategy does. It really just eliminates the positive tail end events while slightly hedging the bottom tail end events. As I've explained so far, this creates an asymmetric payoff that is largely not in your favor. When markets are flat or trending in a sideways direction, yes, covered call strategies can look quite attractive relative to owning the index outright. But financial markets rarely stay in a sideways direction for a long period of time. There are booms and then there are busts. If we are only participating in the bust and not the boom, results will be affected in a negative way. Now, up to this point, I've explained covered call strategies using one option on the entire underlying security and then covering 100% of that underlying security. But know that actual covered call ETFs may cover less of the portfolio. For instance, at 50% coverage, you blend owning stock outright with a covered call strategy. You'll expect to do better over time than the 100% covered call strategy, but that's really just because you own less of the covered call strategy. Also know that typically these ETFs that track an index actually own the underlying stock and then write calls on all of these stocks. So there are a bunch of mini covered calls that make up the entire portfolio. But now let's exit the theoretical world and explain how these strategies do in the real world. We will first take the most popular ETF, QYLD. This is a covered call strategy based on the NASDAQ 100. It's been around since 2014, and when comparing to owning the index outright, we see the dynamics at play that I've been discussing this entire time. The NASDAQ has had incredible growth through this period, growing at 16% per year. The covered call strategy has performed significantly worse at only 6% per year. Now keep in mind we are showing total return here. So the income yield is being reinvested. I'll show a little bit later what happens when we live off of that income yield. But the objection a covered call investor will make is that the covered call strategy has been more stable or less volatile. And that is true if we look at it on an absolute basis. It has 30% less volatility and about 30% less max drawdown. But the trade-off here is 60% less return. And so risk matters in relation to return. We want the highest risk-adjusted total return. And we can see that owning the index outright would provide this. But if you did want to water down the risk and water down the volatility, you could do so in a significantly better way. You could hold quite a bit of cash with the index and still greatly outperform the covered call strategy. And know that the risk protection isn't substantial. If we look at max drawdown, you can see the covered call strategy is slightly better, but not by much. And more importantly, when losses happen, the covered call strategy recovers less quickly due to the upside capping. So what seems attractive on the surface is anything but when we look under the hood. We'll see the same dynamic at play when we look at another large covered call ETF, XYLD. Now this is a covered call strategy on the S&P 500. Once again, we see a substantial reduction in performance, giving up about 4% per year. And in this case, the reduction of volatility and drawdown is even more minor. We see basically the same max drawdown and volatility only improves by about 20%. And so remember in the opening part of this video when I talked about income investing being mostly a marketing ploy rather than something retirees should focus on? Covered call strategies give a perfect illustration of this. Let's go back to taking a look at QYLD. Throughout the life of this ETF, income yields have generally been in the double-digit range. That can look very attractive to those income yield-focused investors. But what if you lived off the income yield and didn't reinvest the dividends? Well, since the inception of this ETF, you'd have lost about 30% of your principal. That means that your income yield is eating into your principal. Your income is also shrinking on an ongoing basis because of that. If we take 10% of a $1 million portfolio in 2014, and then we take 10% of a $700,000 portfolio today, you're gonna have a lot less income to live on. So despite this being an income strategy, owning the index outright would have actually allowed you to take more income. And so should you invest in covered call strategies? Well, data and theory point pretty clearly to that answer being no. There's nothing special about covered call strategies. The market prices both options and stocks quite efficiently, leaving no expected risk-adjusted benefit over time. And so don't get fooled by high income yields. The only variable that matters, the only variable that's ever mattered to you as an investor is risk-adjusted total return. If you're wanting to learn more about the downsides of income investing, click on this video right here. We talk about why income investing is often marketed to investors, but why they should actually be focusing on that risk-adjusted total return. Click on this video to learn more. Always remember, you don't need more money, you need a better plan. Thanks for watching.